Hey friends, my name is Yi and you're watching Yi Makes It Easy, and welcome to a new video for IGCSE Business Studies. And today we have 5.2 for cash flow forecasting and working capital. And by the end of the lesson, you should be able to describe 5.2.1, the importance of cash and of cash flow forecasting, and 5.2.2, the working capital. So check out the pinned comment for all the timestamps, and don't forget to hit the like button and subscribe and ring the notification bell. And we move on to first one, 5.2.1, the importance of cash and of cash flow forecasting. Starting with why cash is so important to a business. Cash is a liquid asset. This means that it is immediately available for spending on goods and services. And the cash flow of a business is the cash inflows and outflows over a period of time. And essentially, in business terms, cash flow means the flow of money into and out of a business over a certain time period. If a business has too little cash, or even runs out of cash completely, it will face major issues and problems, such as number 1, being unable to pay the workers, suppliers, landlords, and governments. Number 2, the production of goods and services will stop, and workers will not work for no pay. And suppliers will not supply goods if they are not paid. And number 3, the business may be forced into liquidation, which is selling up everything like the assets it owns to pay its debts. Then we have what is meant by cash flow. And how can cash flow into a business, or like cash inflow, like the money received by a business? And here are 5 most common ways like cash flow into a business. Number 1, the sale of products for cash. Number 2, the payments made by debtors, and debtors are customers who have already purchased the products from the business but didn't pay for them at the time. Number 3, borrowing money from an external source, and this will lead to cash flowing into the business and it will have to be repaid eventually. Number 4, the sale of assets of the business, for example, unwanted property. And number 5, investors, for example, shareholders in the case of companies, putting more money into the business. And then we have how can cash flow out of a business, which is cash outflows. And here are the 5 most common ways. Number 1, purchasing goods or materials for cash. Paying wages, salaries, and other expenses in cash. Purchasing non-current or fixed assets. Repaying loans, and by paying creditors of the business, which is like other firms who supply items to the business but will not pay immediately. Then we have the cash flow cycle, which is right here. And the following diagram will help to explain the link between some of the inflows and outflows, which is the cash flow cycle. And it explains why cash paid out is not returned immediately to the business. So referring to this diagram, I have this paragraph over here to describe it. The diagram shows how cash is needed. Number 1, to pay for essential materials and other costs. Number 2, required to produce the product, and time is needed to produce the products. So it's a typo. Time is needed to produce the product. Number 3, before they can be sold to the customer. Number 4, and if this customer receives credit, they will not have to pay straight away. But when they do pay for the goods in cash. Number 5, this money will be needed. Number 1, to pay for buying further materials, etc. Number 2, and so the cycle continues. It's like a cyclical structure. Then we have more information. And this diagram also helps us to understand the importance of planning for cash flows. For example, number 1, if a business didn't have enough cash at stage 1 over here, then not enough material and other requirements could be purchased, and so output and sales would fall. And if a business insisted on its customer paying cash at stage 4, because the business was short of money, it might lose the customer to a competitor who could offer credit. Number 3, if a business had insufficient cash to pay its bills, such as for rent and electricity, it will be in a liquidity crisis and it might be forced out of business by its creditors. And these 3 examples illustrate the need for managers to plan ahead for their cash needs so that the business isn't put at risk in these ways. Then we have what cash flow is not. And cash flow is not the same as profit, because profit is the surplus after the total cost has been subtracted from the revenue. And there's a clear difference between the profit made by Good Hope, this right here, this case study, in the case study here, and the cash flow over the same period. You have to see here. So here's the question: why is the cash figure lower than the gross profits? And the answer is because although all the goods have been sold, cash payments buying the goods on the credit were paid in later months. And this important example leads to further questions such as, number 1, can profitable businesses run out of cash? And the answer is yes, and this is the major reasons for business failing, and it's called insolvency. And how is this possible? And it's possible by these ways right here. Number 1, allowing customers too long a credit period, perhaps to encourage sales. Number 2, purchasing too much non-credit or fixed asset at once. Number 3, expanding too quickly and keeping a very high inventory level. This means that the cash is used to pay for higher inventory levels, and this is often called overtrading. Then we have the importance of cash flow forecasts. And as mentioned, without sufficient cash to pay bills and repay loans, a business may be forced to stop trading by its creditors and banks. And a cash flow forecast is an estimate of future cash inflows and outflows of a business, and it's usually on a month-to-month basis. This then shows expected cash balance at the end of each month. And a cash flow forecast can be used to tell the manager how much cash is available for paying bills, repaying loans, and for buying fixed assets. And number 2, how much cash the bank might need to lend to the business in order to avoid insolvency. And number 3, whether the business is holding too much cash which could be put into a more profitable use. Then we have use of cash flow forecasts. And cash flow forecasts are useful in the following situations. Number 1, starting up a business. Number 2, running an existing business. Number 3, keeping the bank manager informed. And number 4, managing cash flow. So here's a cash flow forecast right here. We have month by month basis. We have inflows, outflows, opening bank balance, net cash flow, and closing bank balance. So you notice that net cash flow is labeled as D, and how you find net cash flow is where you do A minus B, the inflows minus outflows. So in January, it will be 35,000 minus 30,000. It's a positive 5,000, so you put it as 5,000. But in February, the inflow is 45,000 and the outflow is 65,000. So that's actually like a negative net cash flow, and we put it in like a bracket, like this. And the positive net cash flow will increase the closing bank balance, like net cash flow, closing bank balance. You add it onto the opening bank balance, like C plus D. And a negative net cash flow, as in February, will reduce the bank balance. You see, negative, it goes into brackets. And each closing bank balance becomes the opening bank balance for the next month. See, 50,000, 50,000. And the bank account will become overdrawn in February, because there's a negative net cash flow and a negative closing bank balance. Then we have the use of cash flow forecast for number 1, starting a business. When planning to start a business, the owner needs to know how much cash will be needed for the first few months of operations. And this is a very expensive time for new businesses, as premises have to be purchased or rented, and machinery must be purchased or hired, and inventory must be built up, and advertising and promotion costs will be necessary to make consumers aware of the product or service. And number 2, we have keeping the bank manager informed. Banks provide loans to businesses. However, before bank managers will lend any money, they need to see firms' cash flow forecasts. And this is particularly true for a new business, but also for an existing one. And the bank manager will need to see how big a loan or overdraft is needed, when it is needed, and how long the finance is needed for, and what it might be repaid. And it is very rare for a bank to lend a business money unless a cash flow forecast is produced, which shows these factors, which I've mentioned in the cash flow forecast, like inflows, outflows, and bank balance. And then we have managing an existing business. Any business can run out of cash and require an overdraft, perhaps because of an expensive non-current or fixed asset being bought or fall in sales. And borrowing money from the bank or any other people needs to be planned in advance so that the lower interest rates can be arranged. Then we have managing cash flow. Too much cash held in the bank account of a business means that this capital could be better used in other areas of the business. And if it seems that the business is likely to have a very high bank balance, the accountant could decide to pay off loans to help reduce interest charge. Another option would be to pay creditors quickly to take advantage of possible discounts. And these are examples of actively managing the cash flow of a business. Then we have the cash flow forecast, which I've mentioned just now. This cash flow forecast, you can see the different labels A, B, C, D, E, and how to find each of this. And here's another example of a cash flow forecast and some activities where you can complete. So if you do these activities, just comment your answers down below and I'll mark it. But we'll move on to the next one. How a short-term cash flow problem might be overcome. And there are several ways in which a short-term cash flow problem could be overcome, and these are explained below, and the limitations of each method are outlined too. Number 1, we have increasing bank loans for methods of overcoming cash flow problem. How it works is that bank will inject more cash into the business, and limitations is that interest must be paid and loans have to be repaid eventually because you're borrowing from the bank. Number 2, delaying payments to suppliers. How it works is that cash outflows decrease in the short term, but suppliers could refuse to supply and suppliers could offer lower discounts. Number 3, asking debtors to pay more quickly. How it works is that cash inflows increase in the short term, and customers may purchase from another business that allows credit for the limitations because the business is asking the debtors to pay more quickly with cash or any other methods. Number 4, delaying or cancelling purchases of capital. How it works is that the cash outflows for purchase of equipment decrease, but limitations is that long-term efficiency of a business could decrease without modern equipment. Then we have how a short-term cash flow might be overcome, like more information. In the longer term, a business with cash flow difficulties will have to take other decisions to solve the problem. These could include the following. Number 1, attracting new investors, for example, by selling more company shares. But will this affect the ownership of a business? And it might if you sell too much of the share to the public or to other people. So essentially, the owner of a business should own at least 51% of the business company share in order to gain the control of the business. And number 2, cutting costs and increasing efficiency. But will this be popular with employees and could produce quality be affected or product quality? And number 3, developing new products that will attract more customers. This could take a long time and needs cash in the short term to pay for development. And then we have 5.2.2 working capital. And here's the concept and importance of working capital. The term working capital refers to the amount of capital which is readily available to a business. That is, working capital is the difference between the resources in cash or readily convertible into cash and the short-term debts of a business. So essentially, working capital equals current assets minus current liabilities. And working capital is the lifeblood of a business, and no business can run effectively without a sufficient quantity of working capital. And a business enterprise with an ample working capital is always in a position to take advantage of any favorable opportunity, either to buy raw materials being offered at a discount or to implement customers' special order. And working capital may be held in different forms. Number 1, cash is needed to pay for day-to-day costs and buy inventories. Number 2, the value of a firm's debtors is related to the volume of production and sales. And to achieve higher sales, there may be a need to offer additional credits facilities. And number 3, the value of inventories is also a significant part of working capital, and not having enough inventories may cause production to stop. And on the other hand, a very high inventory level may result in higher opportunity costs. And lastly, here's some definitions for 5.2 cash flow forecasting and working capital. We have cash flow. Number 1. The cash flow of a business is the cash inflows and outflows over a period of time. Cash inflows. Cash inflows are the sums of money received by a business during a period of time. Cash outflows, on the other hand, are the cash outflows like the sums of money paid out by a business during a period of time, like in and out. Cash flow cycle. A cash flow cycle shows the stages between paying out a cash for labor, materials, and so on, and receive cash from the sales of goods. Then we have profit. Profit is a surplus after total costs have been subtracted from the revenue. And cash flow forecast is an estimate of future cash inflows and outflows of a business, usually on a month-by-month basis. This then shows the expected cash balance at the end of each month. And net cash flow is the difference each month between inflows and outflows. And negative net cash flow will be represented in a bracket in the cash flow forecast. Closing cash or bank balance is the amount of cash held by a business at the end of each month, and this becomes the next month's opening cash balance, which brings us nicely to the opening cash or bank balance at last, which is the amount of cash held by a business at the start of each month. And then we have working capital. And working capital is the capital available to a business in the short term to pay for day-to-day expenses. And that's it for this video for 5.2 of IGCSE Business Studies, where today we look into cash flow forecasting and working capital. And if you find this video interesting and helpful, please leave a like and subscribe, and comment down below if you have any questions or criticisms. Also check out my Instagram in the description for more daily content. And if you've enjoyed this video, don't forget to hit the like button, subscribe, and ring the notification bell so that you don't miss out on any future videos. And that's it for this video, and I'll see you guys in the next video. Until then, stay safe and happy learning.